Welcome to this YouTube channel. In this video, we are going to talk about top 10 investments for financial independence. So before starting this video, please like this video and subscribe to this channel for our future updates. To enjoy a comfortable future, investing is absolutely essential for most people. As 2020 showed, a seemingly stable economy can be quickly turned on its head, leaving those who haven't prepared scrambling for income. But those who could hold on to their investments may have done quite well, as the market registered new all-time highs in the second half of the year. Investing can provide you with another source of income, fund your retirement, or even get you out of a financial jam. Above all, investing grows your wealth, helping you meet your financial goals, and increasing your purchasing power over time. Or maybe you've recently sold your home or come into some money. It's a wise decision to let that money work for you. Risk tolerance and time horizon each play a big role in deciding how to allocate your money. The value of each can become more obvious during periods of volatility. Conservative investors or those nearing retirement may be more comfortable, allocating a larger percentage of their portfolios to less risky investments. These are also great for people saving for both short and intermediate term goals. If the market becomes volatile, investments in CDs and other FDIC-protected accounts won't lose value and will be there when you need them. Those with stronger stomachs and workers still accumulating a retirement nest egg are likely to fare better with riskier portfolios, as long as they diversify. A longer time horizon allows you to ride out the volatility of stocks and take advantage of their potentially higher return. For example, if you're looking to grow wealth, you can opt for lower risk investments that pay a modest return, or you can take on more risk and aim for a higher return. Or you can take a balanced approach, having absolutely safe money now and still give yourself the opportunity for long-term growth. The best investments for 2021 allow you to do both, with varying levels of risk and return. Number 1. High-yield savings accounts. Just like a savings account earning pennies at your brick-and-mortar bank, high-yield online savings accounts are accessible vehicles for your cash. With fewer overhead costs, you can typically earn much higher interest rates at online banks. Plus, you can typically access the money by quickly transferring it to your primary bank, or maybe even via an ATM. A savings account is a good vehicle for those who need to access cash in the near future. Savings accounts are about as liquid as your money gets. You can add or remove the funds at any time, though your bank may legally limit you to as few as 6 withdrawals per statement period, if it decides to do so. Number 2. Certificates of deposit. Certificates of deposit, or CDs, are issued by banks, and generally offer a higher interest rate than savings accounts. These federally insured time deposits have specific maturity dates that can range from several weeks to several years. Because these are time deposits, you cannot withdraw the money for a specified period of time without penalty. With a CD, the financial institution pays you interest at regular intervals. Once it matures, you get your original principal back plus any accrued interest. It pays to shop around online for the best rates. Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income and are able to lock up their money for a little bit. But there are many kinds of CDs to fit your needs, and so you can still take advantage of the higher rates on CDs. CDs aren't as liquid as savings accounts or money market accounts, because you tie up your money until the CD reaches maturity, often for months or years. It's possible to get at your money sooner, but you'll often pay a penalty to do so. Number 3. Government bond funds. Government bond funds are mutual funds or ETFs that invest in debt securities issued by the US government and its agencies. The funds invest in debt instruments such as T-bills, T-notes, T-bonds, and mortgage-backed securities issued by government-sponsored enterprises such as Fannie Mae and Freddie Mac. These government bond funds are well suited for the low-risk investor. These funds can also be a good choice for beginning investors and those looking for cash flow. Bond fund shares are highly liquid, but their values fluctuate depending on the interest rate environment. Number 4. Short-term corporate bond funds. Corporations sometimes raise money by issuing bonds to investors, and these can be packaged into bond funds that own bonds issued by potentially hundreds of corporations. Short-term bonds have an average maturity of 1 to 5 years, which makes them less susceptible to interest rate fluctuations than intermediate or long-term bonds. Corporate bond funds can be an excellent choice for investors looking for cash flow, such as retirees, or those who want to reduce their overall portfolio risk but still earn a return. You can buy or sell your fund shares every business day. In addition, you can usually reinvest income dividends or make additional investments at any time. Just keep in mind that capital losses are a possibility. Number S&P 500 Index Funds. If you want to achieve higher returns than more traditional banking products or bonds, a good alternative is an S&P 500 index fund, though it does come with more volatility. The fund is based on hundreds of the largest American companies, meaning it comprises many of the most successful companies in the world. For example, Amazon and Berkshire Hathaway are two of the most prominent member companies in the index. Like nearly any fund, an S&P 500 index fund offers immediate diversification, allowing you to own a piece of all of those companies. The fund includes companies from every industry, making it more resilient than many investments. Over time, the index has returned about 10% annually. These funds can be purchased with very low expense ratios, how much the management company charges to run the fund, and they're some of the best index funds. An S&P 500 index fund is an excellent choice for beginning investors, because it provides broad, diversified exposure to the stock market. An S&P 500 index fund is highly liquid, and investors will be able to buy or sell it on any day the market is open. Number 6. Dividend stock funds. Even your stock market investments can become a little safer with stocks that pay dividends. Dividends are portions of a company's profit that can be paid out to shareholders, usually on a quarterly basis. With a dividend stock, not only can you gain on your investment through long-term market appreciation, you'll also earn cash in the short term. Buying individual stocks, whether they pay dividends or not, is better suited for intermediate and advanced investors. But you can buy a group of them in a stock fund and reduce your risk. You can buy and sell your fund on any day the market is open, and quarterly payouts are liquid. To see the highest performance on your dividend stock investment, a long-term investment is key. You should look to reinvest your dividends for the best possible returns. Number 7. Nasdaq 100 Index Funds. An index fund based on the Nasdaq 100 is a great choice for investors who want to have exposure to some of the biggest and best tech companies without having to pick the winners and losers or having to analyze specific companies. The fund is based on the Nasdaq's 100 largest companies, meaning they're among the most successful and stable. Such companies include Apple and Facebook, each of which comprises a large portion of the total index. Microsoft is another prominent member company. A Nasdaq 100 index fund offers you immediate diversification, so that your portfolio is not exposed to the failure of any single company. The best Nasdaq index funds charge a very low expense ratio, and they're a cheap way to own all of the companies in the index. Like other publicly traded index funds, a Nasdaq index fund is readily convertible to cash on any day the market is open. Number 8. Rental housing. Rental housing can be a great investment if you have the willingness to manage your own properties. And with mortgage rates hitting all-time lows recently, it could be a great time to finance the purchase of a new property, though the unstable economy may make it harder to actually run it, since tenants may be more likely to default due to unemployment. To pursue this route, you'll have to select the right property, finance it or buy it outright, maintain it and deal with tenants. You can do very well if you make smart purchases. However, you won't enjoy the ease of buying and selling your assets in the stock market with a click or a tap on your internet-enabled device. Worse, you might have to endure the occasional 3 a.m. call about a broken pipe. But if you hold your assets over time, gradually pay down debt and grow your rents, you'll likely have a powerful cash flow when it comes time to retire. Housing is among the least liquid investments around, so if you need cash in a hurry, investing in rental properties may not be for you, though a cash-out refinance is possible. And if you sell, a broker may take as much as 6% off the top of the sales price as a commission. Number 9. Municipal bond funds. Municipal bond funds invest in a number of different municipal bonds, or munis, issued by state and local governments. Earned interest is generally free of federal income taxes and may also be exempt from state and local taxes, too, making them particularly attractive in high-tax states. Muni bonds may be bought individually, through a mutual fund or an exchange-traded fund. You can consult with a financial advisor to find the right investment type for you, but you may want to stick with those in your state or locality for additional tax advantages. Municipal bond funds are great for beginning investors, because they offer diversified exposure without the investor having to analyze individual bonds. They're also good for investors looking for cash flow. You can buy or sell your fund shares every business day. In addition, you can typically reinvest income dividends or make additional investments at any time. Number 10. Bonds. A bond is a debt investment where you loan some money to a corporate or government entity for a specific period of time. This loan may have a fixed or variable interest rate. After this period of time is over, the entity returns your loan with interest on it. In this way, you make a profit. Bonds are less volatile than stocks. Those that have a maturity time of more than 10 years yield better profits than those that have a lower maturity time. While investing in bonds, pick the ones that are guaranteed. This way, you are sure of getting your money's worth. Bonds are well known to be an important part of a diversified, long-term investment portfolio. If you want to watch your money grow steadily over a long period of time, bonds are the investment to make. Investing can be a great way to build your wealth over time, and investors have a range of investment options, from safe lower return assets to riskier, higher return ones. What do you think of our list? Which of the investment you liked the most? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go.